Hello traders. Welcome to TradeTheBear.com. This is Stacy, and just to let you know, I have over 20 years of experience trading various styles, day trading, swing trading, position trading, and then also I've traded binaries, I've traded futures, I've traded options, and of course stocks. So what I want to do today, this is part of our free training series, and this will be the continuation. If you're following our website, and please register and join for free this type of training that we provide at TradeTheBear.com. This particular strategy that I'm going to talk about today is called a diagonal calendar trade. And what we're trying to do with this trade is this is a long strategy. So when the markets are going in the upward direction, this is when we want to implement this trade. And what we're trying to do and what we're attempting to accomplish is we are buying a put. So we're going long we're long put, meaning that we're buying the put position. And we're probably going to buy like a 30 delta. And I'll go into that as I structure a trade here. And then we're going to do that further out in time, somewhere between 14 and 42 days is where we want to pick that up at. And then the other position that we're going to put on for the diagonal is we're going to sell the current week's expiration, or the next Friday's expiration. And with this trade, what we're hoping to do is we're hoping to collect premium with the one that we've sold. And you'll see as we structure this trade how it works. And this is the trade that we're using as we trade XLF in the small account. So I'll try to mimic that particular account's trade as we go through this analysis of this trade. So here we go. So we're on XLF. I went back in time. I went to July 20th, 2018. We have a turn in the market here on the weekly chart. We've had a pretty good move up, okay? So let's say that we have a stop at $27.33, and we're going to be looking at the price of $27.55. Notice that we're 30 minutes before the close. So this is set for Mountain Time, which is where I live, and it just works better for me that way. It might be better in the future if I set that to Eastern Time, just so that everybody's on the same page. But for right now, we're going to do Mountain Time, and you'll be able to see how this is structured. This is a really wonderful trade when you get a nice, steady move up. And most moves that are bullish do not happen with spurts like downward moves will have. So basically what we're doing is we're just slowly, as we see the market slowly starting to climb up, this is a perfect trade for that particular type of market. So as you can see, we're starting to make a turn again, and the daily chart. So take our 27.55. This is how we figure out our risk, and we're going to subtract the 27.33, because that 27.33 is going to be a mental stop that I'm going to have on. So I'm going to create an alert so that if it closes below that, oh, you know what? This may not let me create alerts because we're using on demand. So we'll just draw that line for that. But you would create an alert there, and that's where you would have it. So 27.33 minus the 27.55 is 22 cents. We're trading right now. Let's say we're trading $5,000. So we want to risk 5% of the market. So we're going to do 5,000 times 0.05. So that puts us at $250 divided by our 0.22. So that means we can buy 11. We're going to round up and go to 12 shares. So as we go over here to the trade tab, I'm going to show you this. This is the trade that we're going to be putting on, but I'm going to structure it for you in real time, so you can see how this works. Now you have to buy the call first, and I like to build these buy the put first. I'm sorry, you have to buy your long put first. So I'm going to come over here. And the put that I'm going to buy is I'm going to use a 30 delta. So I believe that comes in at right at 27. So let's see if we go over here to think back, and we go to, okay, so we got the date right. So we're July 20th. And we're going to look for our 30 delta. So that's going to be, yes, the 27. So we want to buy the 27. And how many did we say? We're going to buy 12. 12. Okay. So we're going to put that on. We're going to do that first. And the reason that we're going to do that first is because if we go and we sell the weekly, then we have a naked position. And our margin would be through the roof. So we're going to control our margin, and I'll show you what the margin is here in a second. So the next thing we're going to do is we're going to look at our extrinsic value, okay? That's going to tell us which option has the most interest as well. Now, another thing we need to check is we need to make sure we have open interest, which we do. And so we're going to sell this. I'm going to make it a market order since we're doing it this way. Now, normally you want to walk that order in. So normally you would take this 22 cents and you would put an order out for the 22 cents because you want to capture as much of that as you can. So we're going to take this up to 12, right? And we're going to confirm and we're going to send. Okay, so now we have our position on. Let's look at it here. All right, so we've bought the 12. We've got 28 days until that expires. And oh, one more thing I wanted to tell you. I missed it. This is 24 cents for that, for the 27. The 27.50 is trading at 20 cents. So if this expires, we get to keep that whole 20 cents. And what does that do to this? Now my risk is I've only got 4 cents into the trade. So you can see how the whole idea is to collect enough premium to offset this before it expires. And you have to be careful, as you'll see later in the trade, that we do not want to get within 14 days. So this one's going to go for the next 2 weeks, and then we're going to roll that down here to the September. And you'll see that come into play as we go along. So let's see how the trade does for us. Oh, wait a minute. Before we do that, let's go to Analyze, and let's look at our risk profile on this trade. Now, what was our stop? Our stop was 27.33. So if we go over here to our Analyze tab and we set this on 27.33, now this is a trade, okay? So what we're trying to do is just see how much we would lose. 727, let's say it expires next week, right? So on the 27th, if we go to 27.33, we're going to be right there, right? Okay, so right there. That puts us losing $548. So if this goes, oh, wait a minute. The reason it's more than that is because this has to change to 12. All right, let's try it again. 27.33. We were supposed to risk what? 250-ish. So if everything just tanked on us and it went to 27.33, this graph is telling us we would lose $560. I'm not going to find that. You're not going to find that to be true because the other one should be offsetting it. So this isn't absolutely correct. You can't always trust this, but my engineer buddies say I can, but this one's not calculating out right. But our curve does kind of look like this, and had we not bought this, we would have unlimited risk on the trade. So let's go over here. We can see our margin. We're giving up $600 in margin. So our max loss on this trade would be $600 if it just totally went against us. So that's what that's telling us right there. And all right, so let's look how this develops. So let's go a couple days to the 24th of July. All right, so we made a nice little move up. All right, so what that means is our long put is losing money, but we're collecting premium on the other. So my stop is now going to stay right where it is. Yes, stop is going to stay where it is. So how are we doing on our trade over here? All right, we're up 72 total. We're up 186 on the shorter term. And let's take it to the 26th and look at it again. All right, now you can see we just slowly leaking up. So what I'm going to do now is I'm going to move my stop. And again, it's a mental stop is what this is. So let's activate and let's just move it to right there. All right, so where are we at now? Now we're at 246. We've already, this has already gone to zero. So let's go ahead And just because we don't have to let this expire. If we've collected all of our premium and we have a day to go, let's go ahead and roll it out to the next week. So we're going to create a rolling order, and we're going to go to the next week. We're going to look at our extrinsic value, right? So again, that's going to be the 28 this time. So we're going to change this to the 28. All right, now we picked up another 20-cent credit, right? So let's put that on market and confirm and send. Now we're cooking. Okay. So so far we've made $240, or no, $84. We've picked up 200 and, well, no, that's not right. But anyway, we've picked up some premium. Our call that, or our put that we had purchased is now worth $12.50, and we've given up 150. So we've pulled in some premium, and we're $84 to the good. So let's take it to Friday, and we'll make some adjustments. All right, so still haven't closed above that. So I'm gonna leave my stop right in here. I go back over here and we check our days. We have 21 days left on this. Some of you, we might look at the Analyze tab, and let's go to Think Back, and we're going to go to today's date, which is the 27th, the day that we're doing this anyway. So let's get this out of the way. And we want to know what our delta is. And you can see our delta's dropped down to 16 from the 30 delta that we started with. So if we wanted, and it might be a good decision to do this, let's go ahead and take this 21, and let's see if we roll it out here to a 30 delta. Well, we're probably going to have to go to the 26 delta. That would wind up doing 28 cents. So I'm just going to leave it alone, and we're going to go ahead and take it to the 14 days. All right, so where are we at? We've got 7 days left. We're on a Friday, okay? So we're looking at the expiration for that next weekly here at August the 3rd. So let's go to the Wednesday, and let's see what the chart looks like. So now see how it's starting to go sideways? And we still have the 28, but I promise you we've probably collected a little bit of premium because time is decaying really fast on this. So you can see we're up $78 on that, even though the market's going sideways. And this has gone to 186. So, all right, so let's take it another day to the Thursday, and let's roll to that, or let's go to that date. Okay, well, we had a nice little pullback here, and obviously it's made a slight move back up above this low here that I'm kind of keeping my eye on. So we haven't expired like we did last week. We still are going to have some premium left in this. So what I'm going to do is I'm just going to let it go one more day and just see how it does. Well, if it quit pre-buffering, let's go ahead and just go to the Friday, since we know we're going to do that anyway. Well, here we go. Well, you can see we're up $96 on the trade, so we've got 12 cents of premium left. And let's take it forward one more day, and let's look at our chart again. Okay, nice. So now we're sitting at $28.09 with 30 minutes left on a Friday. How much of that premium is still sitting there? All right, so we were able to catch $234, so now we're up $240 total. So what we're going to do at this point is we are going to roll here. So we're going to roll this, and we're going to take it to, remember, our extrinsic value, right? So we're going to look at that. That's going to be 28 again, and I'm going to make this a market order just for the purpose of this on-demand demonstration. In the real world, you'd use a limit order, and you would walk the order in as best you could. If you didn't have time, you could always do a market order and just lose a little bit in there, maybe a couple pennies is all. So we're going to confirm and send that. And then now, because we're at the 14-day mark on our other one, we're going to have to roll that. So we need to know where we are going to roll to. So we want to take this to August the 3rd. We're going to go to 49 days out. And we're going to look at something that's close to a 30 delta. So we're going to be pulling in this 27. So we want to roll to the 27. So let's watch how we do that. Let's take this put right here. and we're going to create a rolling order. And now we need to change it to September the 21st. So that's going to change to September the 21st. And we are going to, what did I say the strike needed to be? The strike needs to be that 27 still. Okay. So we're going to be changing this to a market order. Confirm send. And all right. So there we go. Now we've bought ourselves a little more time with our protection. That's it right here. Now we're up to 49 days. Our trade price on that was 25 cents. And hopefully this next week we'll pick up 15 cents of premium. So you see how this premium is financing this. So we have to have this to protect ourselves. Now notice that we're 28 to 27 now, so we've got $1,200 in margin that we're using. And you need to kind of pay attention to that a little bit. Sometimes you would go ahead and roll closer to the sold put just so that you didn't have as much margin. Hopefully that'll make sense. Feel free to comment down below on this trade, any questions that you have, and I will definitely follow up with answers. Traders, this is Stacy. I just wanted to show you a live example of what I just covered in the diagonal calendar trade. So it does look a little different when you get into the live chart, where the on-demand doesn't allow you to see the delta, but you can set up your option chain so that you're able to see extrinsic value, delta. If you want to know how to do that, we can definitely put some comments down, and I can put together a video on how you can set that up for yourself. But it's relatively easy, and you can usually figure it out by just spending some time with Thinkorswim or whatever platform you're using. But you want to see your delta, and right here is a live delta, and we're actually on the XLF, and you can see the trade that I have on right now is, this is a 60 delta right here with the 2250. We're trading at 2248, somewhere in this neighborhood. Looks like a pretty big gap in here right now, but the close I think was around 20. Yeah, the last was 22. So it looks like the markets might be up a little bit right now, but we'll see tomorrow morning whenever things opened up. But right here, okay, you can see 61, negative 61 delta on the short term, okay? And then the longer term one that we have on right now is a 36 delta. So if I was building this trade to start right now, I have 25 days. I'm going to use the monthly option. That was something I missed also on the last one. You always want to use the monthly option in this particular strategy. You do not want to buy the weeklies. You only want to sell the weeklies. And you can sell the monthlies too as they get closer and closer to expiration. You can see we have 4 days left and on the particular weekly that we've sold. And then right here, don't pay attention to this over here, the call side, just looking at the put side. So if we were to start fresh right now, we'd go, there's our 30 delta. We'd want to buy the 2050, and we would want to sell the one that has the most extrinsic value is the 22. So that is how we would structure the trade. And as you can see, this is a trade that we have on currently, and one that we've used to increase our small account pretty dramatically this year. So again, thank you for watching. Please comment down below. Please subscribe and to the YouTube channel, and visit tradethebear.com and join for free, and we will definitely make sure that you have access to all of the free training videos. And I hope you're having a good day, and thank you for watching. Bye-bye.